Okay, let's talk about investment legends. When you think about these iconic institutional portfolios, the ones that didn't just do well, but really fundamentally changed the game.
The Yale endowment immediately springs to mind.
Exactly. And David Swensen, the architect behind it, for decades, it was the strategy everyone was talking about,
Yeah.
admiring it, debating it.
Yeah, it wasn't just a tweak on what everyone else was doing. It was like a completely new philosophy for how big institutions should manage their money, built on different ideas about markets and, crucially, their own strengths.
Right. And that's exactly what we're digging into today. We've gathered your sources, articles, research, our notes to really unpack this strategy. It's super influential, widely copied, or at least attempted to be copied, but also, well, really complex.
Mm-hmm.
So our mission is pretty clear. Is the Yale model still a durable blueprint for investing success? Or is it more like, I don't know, an unattainable ideal, something tied to very specific times and advantages that most just can't replicate?
Well, to really get how revolutionary Swensen's approach was, you got to picture the investment scene back when he started at Yale, which is 1985.
Right.
For most endowments, pension funds, big institutions, the standard playbook was, well, pretty staid. Usually a conservative mix, maybe 60% U.S. stocks, 40% bonds. The classic 60-40.
Yeah, the safe conventional wisdom. So Swensen comes in, and he's not just trying to optimize that 60-40 mix.
Not at all. It was a complete break, a real paradigm shift.
Okay.
And it drew a lot from academic thinking, modern portfolio theory, the power of diversification across different types of assets to get better risk-adjusted returns. But it also came from a really practical place understanding Yale's unique situation, managing money for an institution that's supposed to last forever.
So let's dig into that why.
Yeah.
What was the fundamental problem the Yale model was trying to solve?
Yeah.
Because it wasn't just about hitting, annual return targets, was it?
No, the goal was much bigger. For an institution like Yale, meant to exist in perpetuity, the main objective is funding the university's mission forever. That means preserving and critically growing the endowment's actual purchasing power indefinitely to keep up with rising costs, inflation, year after year after year.
Which is a totally different ballgame than, say, saving for retirement or funding a project with an end date.
Totally. And they also think about intergenerational equity, making sure the endowment supports future students and faculty just as well as it does today's.
Okay.
And that traditional bond-heavy portfolio, it just didn't have the long-term growth engine needed to reliably hit that kind of perpetual inflation-beating return.
Okay, so the need for real long-term growth was number one.
Yeah.
And having that super long horizon, that gave Swensen a different perspective on something investors usually fear.
Yes, exactly. He had this key insight. For an institution with basically an infinite time horizon and no sudden need for huge cash withdrawals, they weren't like a bank facing a run.
Right.
What most investors see as a big negative, illiquidity, could actually be a major positive, a benefit.
How so?
Well, by being willing to lock up capital for longer periods in certain types of investments, Yale could tap into potentially higher returns. Returns from assets that just weren't available or practical for investors needing quick access to their money.
So he flipped the script. Illiquidity wasn't a bug, it was a feature. If you could afford it.
Precisely. He saw it as a potential source of premium returns, not just a penalty.
Okay, so grounded in that perpetual mission, the why, and leveraging this long horizon, what were the core principles, the bedrock of the Yale model?
There were really three key pillars. First, a strong, unwavering bias towards equity.
Okay.
Swensen fundamentally believed that over the very long haul, owning stakes in businesses or real assets offered the best shot at the kind of growth needed to fund Yale forever and beat inflation.
Got it. Prioritize ownership for growth. What's pillar number two?
Second was radical diversification, and this wasn't just splitting between U.S. and international stocks or adding some corporate bonds. It meant really pushing into a whole universe of alternative investments. We're talking big allocations to things like private equity, real assets, property, timber, natural resources, and various hedge fund strategies, which they often call absolute return.
Wow, okay, so diversification meant playing on a much bigger, different field.
Exactly. The idea was to find assets that genuinely didn't move in lockstep with regular stocks and bonds to kind of smooth out the ride.
Makes sense. And the third principle?
The third was a deep conviction that certain markets, especially these alternative spaces, are much less efficient than, say, the market for big public stocks.
Less efficient how?
Well, think about private equity deals, or buying a unique piece of real estate, or complex hedge fund trades. There's often less public information, fewer buyers and sellers, higher cost to transact, maybe structural barriers. It's not like buying Apple stock.
Okay, and where there's inefficiency.
There's opportunity. For skilled investors anyway, if markets aren't perfectly efficient, then really sharp active managers can potentially spot mispriced assets, use information advantages or structure deals to get returns above what you'd just get from passive exposure, generate alpha, as they say.
Right.
And this belief made finding and picking truly exceptional external managers, especially in alternatives, absolutely critical to the whole Yale approach.
Okay, so putting it all together, lean heavily into equity-like stuff for growth, diversify like crazy into these alternative areas to manage risk, and then bet big on finding superstar active managers to exploit inefficiencies in those alternative markets.
That's the combination, yeah. It's like taking the core idea of diversification from modern portfolio theory, combining assets that don't move together, and just applying it to a much wider and much less liquid set of possibilities.
But with a huge emphasis on the manager selection part.
Huge. The success wasn't just seen as being in the asset allocation itself, but very much in the who. Yale's ability to find and partner with the best investment talent around the world was considered fundamental.
Okay, that lays out the philosophy, the why. Now let's get into the nuts and bolts, the mechanics, the how. How did this translate into an actual portfolio? Because like you said, it looks totally different from that old 60-40.
Oh, dramatically different. If you look at Yale's asset allocation targets over the years, the most striking thing is just how much they commit to alternatives. The exact numbers move around, obviously, but recent targets and historical levels often show something like 60% of the portfolio in private equity, real assets, and absolute return.
60%? That's a world away from 40% bonds.
Right. Back in 2019, it was right around that 60% mark, and recent targets have still been in that ballpark, maybe 55-60% combined for privates and absolute return.
So let's break down those alternatives again. What are they, and what's each one supposed to do in the portfolio?
Okay, so you've got private equity. That includes things like leveraged buyouts, venture capital. The main goal there is super high growth potential over the long run, and it's where they really try to capture that illiquidity premium by investing in private companies, often for many, many years.
Okay, high growth, illiquidity premium from PE.
Got it.
Then there are real assets. Think real estate, timberland, oil and gas, that sort of thing. These are meant to act as a hedge against inflation, maybe generate some income, and provide diversification because, the price of timber doesn't necessarily move with the stock market.
Right. Inflation hedge, diversification from real assets. Check.
And then absolute return strategies. This is kind of a catch-all for various hedge fund approaches. The aim here is typically to generate positive returns, sort of regardless of what the overall market is doing. So again, diversification and hopefully lowering the portfolio's overall swings.
And what about traditional stuff like plain old stocks and bonds? They're still there, but often as much smaller pieces. Especially fixed income bonds, that's historically been a very small slice for Yale. Swensen's view was basically, why allocate a lot to assets with low expected returns when your goal is long-term growth?
Right. And you mentioned this allocation wasn't just theoretical. It was built around Yale's specific strengths.
Absolutely. Their forever time horizon lets them lock up money. Their tax-exempt status helps with certain investment structures. And they have the size and reputation to do deep research and get access. The portfolio is a direct result of who they are.
So given this really unconventional mix, what's the secret sauce? What's the underlying logic that makes it work, or at least is supposed to make it work?
Yeah, it's more than just the percentages. It's how the principles interact. First, like we said, that radical diversification, going way beyond stocks and bonds into things with genuinely different drivers. The idea is that smooths out returns, lowers overall risk compared to being concentrated.
Extreme diversification almost.
You could say that. Second, really capturing that illiquidity premium, that's absolutely key. Yale consciously chooses to tie up huge amounts of money for years, sometimes a decade or more, because they believe the market pays you extra for doing that, for giving up liquidity. Right. And Yale, with its long fuse, is perfectly positioned to collect that premium.
They can afford to be patient, and they expect to get paid for it. Okay, what's the third ingredient in the sauce?
Exploiting those inefficiencies through active management. The belief that in these less transparent, harder to access markets, private equity, complex real estate deals, a really skilled manager can find value others miss, negotiate better terms, execute strategies that beat the market average.
Right.
And that's why finding, vetting, and partnering with these elite outside managers became maybe the single most important job of the Yale Investments Office. They're famously rigorous about it.
That makes sense. So the secret sauce isn't just the ingredients, the asset classes, but the whole process. Figuring out where you have an edge, having the resources and access to play there, and then having the people to pick the right partners to actually execute.
Exactly right. The success is totally tied up with Yale's execution capability. Can they actually get into the best private equity funds, which are often closed to new investors? Can they manage those relationships effectively? It takes a big internal team doing nothing but research, due diligence, monitoring. It's anything but passive.
Okay, but this kind of ambitious approach,
Yeah.
it must come with some serious costs and trade-offs, right?
Yeah.
What are the big downsides?
Oh, definitely. Big drawbacks. The most obvious ones are complexity and cost. This is a hugely complex, actively managed strategy. You're paying big fees to all those external managers, private equity firms, hedge funds, real asset folks. Plus, you have the significant cost of running Yale's own sophisticated internal investment office.
Right, compared to just buying a few low-cost index funds.
Exactly. Some critics figure the total cost for institutions deep in alternatives could easily hit like 2 or 3% of assets every single year. And they argue it's incredibly hard, maybe impossible, to consistently generate enough extra return, enough alpha to clear that high fee hurdle year after year.
Wow, yeah, 3% off the top is a massive headwind if you're not getting truly stellar results.
It really is. Another major cost is the illiquidity itself. Yes, it offers a potential premium, but it means a huge chunk of the endowment is locked up tight. If Yale suddenly needed a ton of cash, say, for some unexpected crisis or a massive opportunity selling off those private equity stakes or direct real estate holdings quickly, that would be extremely difficult, probably force them to sell at big discounts. Swensen himself acknowledged this risk, especially during market turmoil.
So the very thing offering the potential reward is also the biggest constraint if you need cash fast.
That's the trade-off. And there's also the risk of underperforming in certain markets. Think about periods when public stocks, maybe U.S. large caps, are just roaring ahead. A portfolio loaded with alternatives, which might move differently or react slower, could easily lag behind. We've actually seen that happen in recent years.
And you mentioned the reliance on managers. That sounds like a huge risk factor, too.
Oh, absolutely. Depending so heavily on active managers means your success hinges on consistently picking winners. Managers who not only beat their specific benchmarks, but do it by enough to cover their hefty fees, and then some.
Which is notoriously hard to do.
Incredibly hard. Swensen himself was very clear about this. Very few institutions and almost no individuals have the skill and resources to reliably beat the market through manager selection. If you pick mediocre managers or if the fees just eat up all the outperformance, the whole strategy can fall flat or worse.
It really sounds like the things most critical to its success, the manager selection, the access, are also the hardest parts to scale or copy.
Yeah, that's often called the Achilles heel for anyone trying to replicate the Yale model. Things like getting access to the best global deals, being invited into the top private funds that are often oversubscribed, having that internal team capable of picking winners consistently. These depend so much on Yale's unique brand, its huge alumni network, decades of experience. These aren't advantages you can just buy off the shelf.
Right. It makes you wonder, with all this complexity, these trade-offs, how does a portfolio like this even stay on track over time? Markets go crazy. Values shift.
That's where rebalancing discipline is absolutely vital.
Yeah.
Over time, some asset classes do better than others, so the actual percentage weights in the portfolio drift away from the targets set in the investment plan. Rebalancing is just systematically selling what's grown too big and buying what shrunk to get back to those target weights.
So it's not just setting the targets, but actually sticking to them rigorously.
Rigorously is basic risk management. It stops you from accidentally ending up with all your eggs in what our basket just had a hot run. And it forces a kind of buy low, sell high discipline based on percentages, not market timing guesses. Swensen always hammered on the long-term view, and rebalancing is key to maintaining that strategic allocation and not freaking out over short-term noise.
What's interesting, though, is you mentioned they use passive tools sometimes, even with all this focus on active management. How does that fit in?
Yeah, that's a neat, sophisticated part of it. While the core strategy bets heavily on active managers and alternatives, reports suggest Yale uses passive things like index funds and ETFs for more tactical adjustments or for making small tweaks when they rebalance.
So not to pick stocks, but to manage the overall mix.
Exactly. They can use these highly liquid, low-cost ETFs to nudge the overall portfolio back towards its target asset class weights efficiently.
So they can adjust the big picture quickly with liquid stuff without trying to constantly trade those hard-to-sell private investments.
Precisely. Since most of the core portfolio is locked up long-term in these illiquid funds, trying to rebalance those directly would be slow, expensive, often impossible when you want to do it. So using a layer of liquid ETFs gives them flexibility to manage the overall strategic targets much more effectively as markets move.
So it's like a two-tiered system.
Kind of. You have the strategic illiquid core managed actively for the long haul, and then a more nimble liquid layer used pragmatically to keep the overall ship on course.
Okay, we've got the why and the how. Now let's talk performance under pressure, the big one. How did this strategy handle the 2008 financial crisis? That was a huge test.
Oh yeah, the global financial crisis was a massive stress test. For the fiscal year ending June 2009, the endowment took a big hit, down 24.6%.
Ouch, nearly 25%. How did that stack up against everything else falling apart?
Well, context is key, right? In that same period, global stock markets absolutely cratered, down closer to 30%. So, while Yale's loss was painful, it was actually less severe than just holding stocks. Their portfolio was very equity-like in its risk exposure, over 95% equity risk at the time, they estimated. But the diversification did provide some buffer relative to pure public equities.
Interesting. Did different parts of the portfolio react differently?
Yeah, it was pretty nuanced. The more liquid stuff, public stocks, bonds, their absolute return strategies that collectively fell by a smaller 13.1%. And interestingly, the absolute return piece, the hedge funds, actually did relatively okay in that chaos, down only about 9%. Still negative, but way better than the market.
Okay.
And their active public stock managers also beat their benchmarks.
So where did the really big pain come from in 08-09 for them?
Maybe surprisingly, the biggest drag came from the real assets, bucket, real estate, timber, etc. That was actually their largest allocation slice going into the crisis, and it plunged almost 34%, which just highlights something critical. In a true systemic meltdown, correlations can spike. Stuff that's supposed to be uncorrelated suddenly moves together as everyone just sells whatever they can. Even broad diversification across asset names doesn't guarantee protection when the underlying economic drivers get hammered everywhere.
So the main lesson from 08 seems to be, okay, they weren't immune to huge shocks, but being a big institution with that long horizon meant they could take the hit on paper without being forced sellers at the bottom.
Absolutely. Their ability to just hold tight, ride out the storm, and wait for recovery was a massive advantage. Most others, especially individuals, just don't have that luxury.
Okay, that was a crisis of liquidity and credit. What about a different kind of stress? Like this potential shift we might be in now, moving away from decades of low inflation and falling interest rates. How does the Yale model look in a world with higher inflation and rising rates?
That's the million-dollar question right now, maybe $1 billion for Yale. The model is designed with some inflation protection in mind, mainly through those real assets. The idea is that the value of property, timber, resources should generally rise with inflation.
Okay, so there's a built-in hedge, theoretically. But higher interest rates, that must create problems elsewhere.
Oh, for sure. Higher rates make debt more expensive. That directly impacts leveraged buyouts, which are a huge part of private equity. It can slow down new deals, potentially lower future returns from that whole sector.
Right.
And as Yale's current CIO, Matt Mendelson, has noted, higher rates and general economic uncertainty also tend to choke off the exit markets for private assets, IPOs, sales to other companies. That makes it harder for PE funds to sell their investments, realize gains, and return cash to Yale.
And what about the overall heavy lean towards equities? That worked great when rates were falling, but now?
It could face more headwinds. If inflation sticks around and eats into corporate profits, or if higher rates just mean stocks trade at lower valuation multiples overall, well, the long-term case for equities is still there, but the ride might be a lot bumpier than the smooth, mostly up journey Swensen enjoyed during that long period of falling rates and low inflation.
And we've seen some recent performance numbers that maybe reflect this. Fiscal 23 was, 1.8% return? And FY24 was 5.7%. Those definitely lagged the big gains in public stocks over those periods.
Yeah, and Mendelson basically said they expect to lag public markets in times like these, especially when those private exit markets are sluggish, which they have been. It really suggests that those amazing historical returns under Swensen got a significant boost from those multi-decade tailwinds falling rates, low inflation that lifted almost all asset values and made leverage cheap.
So matching that past outperformance might be a lot harder going forward, even for Yale itself.
That seems plausible. And it's interesting, there were reports about Yale considering selling a big chunk of its private equity stakes, this Project Gatsby thing. Some see that as maybe a practical adjustment to this tougher environment for getting cash out of private deals.
This really brings us back to that core issue, replicability. Given the complexity, the costs, relying on all those unique advantages, why is it so darn hard for almost anyone else to copy the full Yale model?
It really boils down to Yale's entire ecosystem. Their global brand just opened her doors, that massive alumni network. It's an incredible source of deal flow, information, access to the absolute top-tier private funds, the ones that are often closed to outsiders.
Right.
Then they have that large, highly skilled internal investment team solely focused on this portfolio. They have the prestige to attract the best financial minds to work there. Most institutions, forget about individuals, just don't have that whole package.
It's not just the money, it's the whole machine around the money.
Exactly. And then layer on top the huge fee burden we talked about and what some call the manager lottery. Your success completely depends on consistently picking managers who deliver knockout returns after charging you exorbitant fees across multiple complex asset classes year in and year out.
Yeah, the odds seem tough.
Incredibly tough, even with Yale's resources. A lot of Yale's past glory is attributed to Swensen's genius and his team's skill in playing that incredibly difficult manager selection game. That's not something you can just bottle up and sell.
Okay, so given all that, who is the full-fat Yale model actually for? Who is it a good fit for?
It's a very, very small club. You're talking large, extremely sophisticated institutions that basically mirror Yale's key traits. A perpetual or super long-term horizon, massive internal expertise and resources for deep due diligence, proven access to the world's best alternative managers, and a strong patient governance structure that can handle the complexity and volatility.
Like who specifically?
Think other giant university endowments, maybe the biggest foundations, some of the large sovereign wealth funds from various countries. It's not just about having billions in assets under management, AUM. You also need what you might call sophistication AUM.
And who is it definitely not for? Who should steer clear of trying this at home?
Pretty much everyone else. The average individual investor, absolutely. And frankly, most smaller or even medium-sized institutions, too.
Why not then?
They just don't have the scale to meet the huge minimum investment sizes for the top private funds. They usually have shorter time horizons, maybe need more liquidity. They lack the internal staff and expertise for the kind of due diligence required. And the sheer complexity, the lack of transparency, and those incredibly high fees of the institutional version, It would likely be counterproductive, maybe even disastrous for their goals.
Okay, so for 99.9% of us investing exactly like the Yale endowment, it's just not happening. But does that mean it's useless?
Yeah.
Are there any lessons we can take away? Can individuals or smaller players apply the principles, maybe in a simplified form?
Oh, absolutely. And this is where Swensen himself gave some really practical advice, specifically for individual investors, in his book Unconventional Success. He didn't say, go try to find a private equity fund. No.
What did he recommend instead?
He basically outlined a much simpler, low-cost portfolio using publicly traded index funds and ETFs. Kind of a Swensen-light or DIY version that takes the core philosophy but adapts it for regular investors' reality.
Okay, tell me about this simplified DIY model. What does it look like, typically?
Well, there are different variations, but a common setup might include big chunks in broad U.S. stock market ETFs, international developed market stocks, maybe some emerging market stocks too. Then you'd add publicly traded REITs real estate investment trusts as a liquid way to get some real estate exposure. And on the bond side, U.S. Treasuries and TIPS, the Treasury inflation-protected securities.
What's the logic behind that particular mix for an individual?
It tries to capture the spirit of Yale's core ideas, but with tools anyone can access cheaply, you get broad global stock exposure for that long-term growth bias. REITs give you a taste of real estate performance and maybe some inflation sensitivity, even though they trade like stocks. And treasuries and TIPS provide stability, some income, and that explicit inflation protection on the fixed income side.
Okay.
So it keeps the equity focus and the diversification idea, but all within the world of liquid, transparent, low-cost public markets.
So what are the big trade-offs then, comparing this DIY version to the real deal at Yale? What do you gain, what do you lose?
The main thing is you get absolutely no true exposure to illiquid alternatives. REITs aren't the same as owning private timberland or a venture capital portfolio.
Right.
What you gain is simplicity, total illiquidity, and drastically lower fees. Your returns will basically track the public market indexes, minus tiny fees. What you explicitly give up is that potential extra return from the illiquidity premium and the potential alpha from superstar managers finding deals in inefficient private markets.
Got it. So you trade the complexity and potential upside of private markets for the simplicity, liquidity, and low cost of public ones.
That's the trade-off, exactly. And if you backtest these simplified index fund models, they tend to perform much more like a standard 60-40 portfolio, or maybe like the average large endowment, not like the historical top percentile results Yale achieved under Swensen, which were really juiced by those successful alternative bets. It's a different model for a different investor profile.
And the fact that Swensen himself pushed this simpler, accessible DIY approach for individuals, instead of suggesting they try to somehow mimic Yale's private access, that feels like a pretty strong message, doesn't it?
Oh, it's incredibly pragmatic, very honest. It's basically admitting that the full-blown, resource-guzzling institutional model is just not appropriate, not even possible for most people. His advice for individuals was a totally separate framework, tailored to their constraints. Less capital, less expertise, more need for liquidity, and the reality of retail fees.
Okay, so stepping back from all the specific assets and percentages, after digging into all this, what's the big takeaway? What's the most important enduring lesson from Swensen's work in the Yale model that applies to all of us, no matter how much we're investing?
Yeah, it's really not about trying to copy their exact portfolio or chasing private equity deals. The most powerful lesson, I think, is the importance of having a deeply thought out, disciplined, long-term investment philosophy that is genuinely built around your specific goals, your time horizon, your constraints, and then having the discipline to actually stick to it.
Right.
It's about having the courage to maybe challenge conventional wisdom when it makes sense for you based on solid reasoning, but always doing it within the context of your own situation.
So it's the process, the thinking, the discipline, much more than the specific investments themselves.
Exactly that. The principles embedded in how Yale approached this are timeless, and they apply to everyone. Things like really understanding why you're investing, what are your goals, how long is your runway, identifying and maybe leveraging your unique advantages, even if that's just having patience or being able to use low-cost funds, building a framework, a plan that actually reflects those goals and advantages. And then this is the hard part, executing that plan with unwavering discipline.
Sticking to it, rebalancing, not panicking.
Right. Resisting those emotional short-term reactions. So while the what you invest in will probably look very different from Yale's portfolio, the how you go about building and managing your investments, the philosophy, the plan, the discipline, those are the really powerful transferable lessons here.
That's the enduring wisdom, it seems. A call to be really strategic and thoughtful about your own investment path, whatever your scale.
Well put.
Okay, and that wraps up our deep dive into the Yale endowment model, a strategy that, truly did reshape institutional investing, showed what could be possible with unique strengths and incredible discipline.
Yeah, but also one where the most valuable lessons for the rest of us probably lie not in trying to mimic the investments, but in understanding and applying the underlying philosophy and process to our own situations.
So the final thought for you, the listener, as you think about your own long-term plans, how can you apply these core principles, disciplined, long-term thinking, aligning strategy with your unique situation, and advantages, even if that whole world of private equity and exclusive hedge funds is completely off the table for you? Thanks for joining us for this deep dive.